Meta Platforms just dropped earnings, and the market didn't like what it saw. 8%. Gone in a single session, EPS missed. Revenue guidance came in soft. And free cash flow, the number that has anchored Meta's entire bull case for years, is under pressure. So is this the beginning of something serious? Or is the market overreacting to one bad quarter from one of the most powerful businesses ever built? I ran Meta through 5 institutional research frameworks, the same tools used by professional analysts, to find out what's actually going on. Let's get into it. Meta is an advertising machine. Facebook, Instagram, WhatsApp, Threads, 4 of the most used apps on Earth, all running on a single business model. Show you things you care about, then sell access to your attention. About 97% of Meta's revenue is advertising. That number hasn't changed in years. What makes Meta different from other ad platforms is what they call the social graph. They don't just know what you searched for, they know who you know, what you talk about, what you like, and how you feel. That targeting precision is genuinely hard to replicate. Now, the company also has a second segment, Reality Labs, Quest headsets, Ray-Ban smart glasses, the whole metaverse vision. Here's the honest truth about Reality Labs. It burns $4 to $5 billion a year in operating losses. Every year, for years, it is not a business. It is a research and development bet, an expensive one, carried on Meta's income statement. The good news is that the core advertising business generates enough cash to absorb those losses. At least it did until recently. Which brings us to Q2 2026. Here's what happened in Q2. EPS missed consensus. Revenue guidance came in below expectations, and management narrowed their capital expenditure range, which sounds technical, but it matters enormously for what comes next. The market's reaction, an 8% sell-off, tells you something important. Investors had priced in continuation of the beat and raise cycle Meta had been running. When you miss and cut guidance at the same time, that's not noise, that's a signal. Now, the revenue miss has 2 possible explanations. 1, macro softness. Advertising budgets, especially from small and medium businesses, are the first thing to get cut when the economy gets shaky, and Meta skews heavily toward SMB advertisers. 2, the AI tailwinds simply haven't offset the headwinds yet. Meta has been making enormous bets on artificial intelligence, llama models, Advantage Plus automated ad campaigns, AI creative tools. Management says AI is accelerating the core business. But if it's accelerating the business, why did guidance disappoint? That's the tension at the heart of this earnings report. Before we get to the numbers, let's talk about whether Meta's competitive advantage, its moat, is actually intact. The short answer is yes, but it's narrower than it looks. Meta's real moat is the social graph. 3.3 billion daily active people. Your connections, your memories, your communication history, that doesn't transfer to another platform. It stays with Meta. Advertisers can't leave either, not easily. Their audience data, their pixel integrations, their campaign history, it's all embedded in Meta's ecosystem. What Meta does not have is a technology moat. Llama is good, but it's not defensible. Reality Labs has spent $50 billion and doesn't have a hit product yet. The enterprise push is early and unproven. The honest moat verdict: Meta's core social and advertising advantage is real and durable. The AI and hardware ambitions are still bets. Now let's talk about what the stock is actually worth. I ran a full discounted cash flow analysis across 3 scenarios. Base case, assuming 11% revenue growth in the near term free cash flow margins recovering to around 30% as capital expenditure normalizes gets you to roughly $276 per share in intrinsic value. Blending that with comparable company multiples, EV to EBITDA, price to free cash flow, lands the fair value range around $274 to $308. Bull case: if AI delivers, WhatsApp monetizes, and free cash flow recovers to 38% margins, pushes the model to around $409. Bear case: capex trap, ad market slowdown, regulatory pressure, floors out around $147. The market is clearly pricing in significant AI optionality premium above those model outputs, which means the bull case has to deliver. And the Q2 miss just made that a harder ask. The most fragile assumption across all three scenarios is the same: free cash flow margin recovery timeline. Everything else is secondary. Here's the thing that makes Meta different from most companies having a rough quarter. They are betting the company on artificial intelligence, not metaphorically, literally, tens of billions in annual capital expenditure on data centers, custom AI chips, and model development. The Llama open source model, the Advantage Plus ad system, Meta AI as a direct competitor to ChatGPT. The bull case on this bet is genuinely compelling. If AI makes Meta's ads so much better that every dollar of ad spend generates more return for advertisers, Meta can raise prices, expand margins, and grow revenue without needing more users. That's a powerful flywheel. But here's the problem. Right now, the costs of this bet are fully visible on the income statement. The revenues, the actual monetization, are not yet quantified. Investors are being asked to trust that tens of billions in annual infrastructure spending will eventually convert to proportional revenue. And the Q2 miss makes that trust a little harder to extend. Zuckerberg's credibility on capital allocation, not on vision, is the variable that determines whether the next 18 months is an accumulation opportunity or a value trap. Every framework I ran on Meta pointed to the same conclusion: free cash flow trajectory in Q3 2026. That's it. That's the number. If Q3 shows free cash flow stabilizing, margins above 28%, with management signaling that capital expenditure has peaked, the bull case reasserts strongly. The Q2 miss was noise. AI is working. The market re-rates. If Q3 shows free cash flow continuing to compress, margins below 22%, capex guidance maintained or raised, the market will begin repricing Meta from a high-quality cash generator to a capital-intensive infrastructure bet. And that multiple compression would be severe. The free cash flow line in Q3 is the verdict on whether Zuckerberg's AI bet is genius capital allocation, or the most expensive gamble in the history of digital advertising. Watch that number. Everything else is secondary. This analysis was produced using Norris AI AlphaLens, 5 institutional research frameworks on Meta, synthesized in plain English by Claude AI. You can run the same analysis on any US stock. Earnings, quality analyzer, fair value stress test, bull versus bear, competitive moat, catalyst calendar. All 15 frameworks available right now. The link is in the description. Use code Reddit-free-trial to try it free. No credit card required. If you found this useful, subscribe. We publish a new institutional analysis every Friday. The stocks everyone is talking about, run through the frameworks professionals actually use. I'll see you next week.